Exchange-traded funds, more commonly known as ETFs, have quickly become the investment of choice for people wanting to invest their money passively while getting great returns. ETFs are a financial instrument traded on the market exactly like a stock, meaning you can buy or sell them as you please if the market is open. I think of ETFs as a basket of assets. Each time you invest money into an ETF, that money is spread into all the assets in its basket, with the amount going to each asset depending on its weighting in the ETF. For example, if a particular asset weighting is 1.6% and you invest £100 into the ETF, £1.60 of that will go into the asset. The assets that can make up an ETF are company stocks, bonds like government or corporate, commodities such as gold or crude oil, and currencies. ETFs will usually focus on a particular asset type. For example, many ETFs just include stocks and many different ones to give diversification, whereas ETFs that track commodities commonly just track the price of a single asset, like gold. The price of ETFs move depending on the price movements of the asset that it makes up. For example, if a stock has a 5% weighting in an ETF and has a great day, increasing 10% in value, its impact on the ETF will be a 0.5% price increase. But if a different stock in the ETF with the same 5% weighting goes down 10%, the opposite will happen and decrease the ETF price by 0.5%, cancelling out the previous stock's movement. All of the ETF's assets combine, which decides whether the ETF price will increase, decrease, or stays the same as each day progresses. Most ETFs are structured as passively managed funds, which means they are designed to follow an underlying benchmark, like the FTSE 100 or S&P 500 indexes, as closely as possible. These ETFs can be great for getting exposure to a particular market, which is desirable with markets like the United States that usually go up, averaging around 7% gain each year. There are passive ETFs that focus on more specific areas, like particular sectors or companies that's dividend history meets a minimum standard. Due to these passive ETF simplicity, they often have low fees. For example, the management fees for most S&P 500 ETFs is less than 0.1%. There are also actively managed ETFs where a fund manager takes a hands-on approach to choose the assets for the fund. These portfolios are usually more concentrated in securities that the management team deem likely to outperform. As these funds require a whole team of analysts to run, they typically have a much higher expense fee to own. An example of an actively managed ETF are the funds that ARK Invest runs, with each fund up at least 100% during 2020. When the assets being held within an ETF payout income, such as bonds and stocks, the ETF will pay this to shareholders in the form of a dividend. An ETF will either be distributing or accumulating. Distributing means that the dividend is paid in cash to the holders of the ETF. Accumulating means that the dividends from the ETF assets are automatically reinvested back into the fund, meaning that the fund's value increases. To find out whether an ETF is distributing or accumulating, check out the end of its name. Distributing ETFs will usually have a DIST at the end, and accumulating ETFs will usually have an ACC. Accumulating ETFs are advantageous if you pay a transaction fee to your broker for each trade, as it eliminates the commission. As I use a commission-free brokerage, I do not get any advantage from an accumulating ETF, so I prefer distributed ETFs as I can decide what I want to do with the money. The main reason that investors have been flocking to ETFs in the masses, primarily passively managed ones, is as they historically beat most actively managed portfolios over the long term. The majority of losses from investing are caused by human emotion, such as greed and complacency. These errors are eliminated by investing in a passive ETF. Thanks for watching guys, drop a like if you found that useful.